All right, welcome everybody to the October 2019 special edition of the Roundtable entitled Tricks or Treats. This is our monthly series that we've been doing now for 9.25 years to be precise. We are in our 10th year, and my name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors of this event, and I'm joined here by my dear friend Ken Kabula from the central Michigan area. He's now a volunteer leader in this area. He does presentations and educational stuff nationwide, but I think he's responsible for pretty much all of Michigan now. Pretty close, huh, Ken?
Well, there's still a Western Michigan chapter and a Southeastern Michigan chapter, Mark, but we have a big swath right up the middle of the state, okay?
So you just haven't summed up the masses to charge and take over like the Canadians invading the
I'm
United States?
I'm gonna direct you just to keep moving them out of this program, okay?
We're also joined here by Cy Lynch, who's been talking about the Atlanta Braves indirectly. That is him on the screen wearing his Atlanta Braves attire. He also has been doing this for uh, quite a while, multiple decades. Welcome, Cy.
Yeah. Thank you, Mark. I think about 35 years, something like that. So
And
I was a little upset that Jay did not recruit me into his investment club when I was 2, but
there you go.
uh,
All right, and Hugh McManus also joins us regularly on these events, but he's quite the world traveler, and he's actually in the middle of travel now. He may join us before the end of the session. So again, this is our October session. We generally really amp up the activity on small company stocks and attempt to distinguish between them being tricks or treats, and we'll be covering that a little bit here tonight also. First, a little bit of the legal paperwork. No investment recommendation whatsoever is intended here. This is all about education. It's about a demonstration of the philosophy and the methods of the modern investment club movement as it's interpreted by people like NAIC / Better Investing and or Manifest Investing. We simply are out there attempting to discover excellent companies and buy them when they're on sale or at the right price. Any opinions that we express here tonight, because we do use real companies in real time to demonstrate the method, treat that as our own, do your own homework. We may actually hold some of the stocks that we talk about. We do call that out when we encounter one of those situations. We learned that we have a new attendee here tonight in the green room. And again, if you're new and you would like to receive event reminders about these events and the other educational and theme events that we do, please send an email to nkavula1@comcast.net. That's Ken's significantly better other half, Natalie, who takes care of the email list for this event. She will not inundate you with email. You'll probably get one or two notices of upcoming webcast opportunities. If you'd like copies of the slides that we use here tonight, or you have any Q&A follow-up type things, you can send an email to markr@manifestinvesting.com. All right, this is pretty much our standing agenda for us in our 10th year. Again, welcome, especially if you're new. An extra big hug to you if you're new. We really are here for the purpose of sharing ideas and demonstrating the methods and philosophy. That's what we do. Point number 2, we do keep track of how well we do. We'll talk about that here in a minute, how well we've done over these last 9+ years. Point 3, this notion of challenges, this comes up as companies that are in the tracking model portfolio that we may be looking to sell. It's referred to as a challenge situation. You'll see 3 stock presentations. Ken's going to do Alphabet Google. Cy is Texas Roadhouse. And I'm going to bring BioSpecifics Technologies. And Hugh, if he's able to join us before the end of the session, I'm guessing he might be accumulating another position in Ardelyx, ARDX, but that's just conjecture on my part. We do poll the audience at the end. Even if it's your first time here, you're invited to participate in that poll. And we generally wrap this up in about 75 minutes or so, and we do stick around for open Q&A at the end. So let's go ahead and keep rolling. We've been doing this again since 2010. We are attempting to share we're attempting to share one of our single favorite and perhaps actionable investment opportunities. Anytime you see the word actionable, that is not dial your broker and place an order or punch keys and place an order. It means study it, and come to grips with the situation, form your own judgments and conclusions. We do welcome some special situations or non-core selections into the portfolio, and the whole idea is to take the collective set of decisions and beat the market by 5 percentage points. We use the Wilshire 5000 as the stock market, and we want to beat that by 5 percentage points over the long term, and that is an ambitious goal, as we know over these past 8 decades. We would like to see over half of our selections actually beating a mirroring investment as if you had invested just into an index fund for the total stock market. Here is the track record of how well we've done. And again, it's a moment for reflection and maybe a little bit of cyber applause. Our rate of return since we started doing this is 17%. If we had invested those $1,000 decisions into the Wilshire 5000, the return would be 11.3. Therefore, 17 minus 11.3, it gives us a relative return. It's the answer to the question, how much are you beating the market by? That's that 5.7%. And we see about half of the time our picks have actually beat the market. So what the graph shows us, again, we're operating up near those all-time high levels relatively. The long-term goal for most investment clubs and most individual investors in this community is to try to beat that market by 5 percentage points. That's what the red dotted line is across the middle. And of course, we would like to stay there. Any comments or questions, Ken or Cy?
I just think it's really interesting that all of this stuff that we talk about on a regular basis actually works, Mark, you know?
Well, we heard it from Jay Berry in the green room. It's worked for him for many decades. So,
Sharon, the answer is 17% average annual return. So that's annually. And similarly, the 5.7 relative difference is an annualized return. And the only thing that I'll point out, while 48% is a bit below our goal of 60s-ish or so, it's always important to remind ourselves that you can be, quote, wrong, as in underperform the market half the time and still meet your goal, because the whole key to much of this is to limit downside potential. And that's what our methodology, I think, does very well by picking quality stocks. So even if you only beat the market by 1 to 3%, when you have some that do extremely well and beat the market by 10 or greater, which we will have some of those and do have some that even do better than that, that can counterbalance the others. So don't get discouraged when you don't achieve the 5% goal for every stock.
You know, I would just add a couple.
Maybe, Cy,
Go ahead, Cy.
maybe Cy, when spring training comes around, we need to do a presentation on how many times you have to actually hit a home run to keep your portfolio moving forward.
There you go.
Oh, like he needs any nudging to write about baseball and investing. Yeah, one thing I do like to point out, we haven't done it in quite a while here, is just to give some context and perspective. The average investor, based on what we've seen over at the Motley Fool's CAPS experiment that they have, achieves an outperformance accuracy of about 30%. The average investor actually comes in at about 30%. The reason for that is chasing hot stocks and hot stock tips from your brother-in-law or the hair salon. And that's what causes that. It's basically performance chasing that causes that. So to be at 48 is actually above average. The other thing I just wanted to point out is when we're at 17% and we're beating the market by 5 or 6%, it's tough to stay at those elevations. I mean, the fact that we've been there for the last few years, that's been some strong annual performance there the last couple of years. It's good to watch it unfold. All right, so let's go ahead and talk about the portfolio itself. This is a snapshot, an excerpt of the tracking portfolio. You can actually see all of the holdings using that link at the top of the page. And what every one of these positions is, every time a decision is made, whether it's one of us or a guest damsel or the audience, basically placing a vote or making a selection, we place $1,000 into the stock. So in the case of Microsoft, you can see that, let me stoke up my pen here, trusty pen. In the case of Microsoft, it's actually been chosen 5 times. Over here on the far right, you can see it in the legend up at the top. So $5,000 has been invested in Microsoft during this 9.5-year period. That $5,000 is now worth $31,000. So Microsoft is our largest position at 7.2% of total assets. And you can just kind of work your way down the list and you'll see several community favorites and household names, and then some other that are not quite so familiar, a little bit off the majority of investors' radar screens. And those are the companies we really do like to discover. Any comments, Cy or Ken?
I just did the Fortune 100 fastest growing companies list today, Mark. I put it into the Manifest website as a public dashboard. So those of you that haven't taken a look at it can go take a look at it. And I'm impressed by the number of companies that we seem to grab near the beginning that are on that fastest growing list. The one that comes to mind immediately is EPAM Systems, which when Cy first brought this one to the roundtable, I was familiar with it only because of its being a competitor of Cognizant. I hadn't really taken a good look at it, and yet only being chosen 5 times, giving us almost, a little bit over $9,000. And this is a relatively new addition to the portfolio. These kind of stocks are the ones that we're just always on the lookout for to help us keep this portfolio above that beat the market by 5% goal that we've set for ourselves. There's certainly a lot of high growth on this list, and I challenge anybody to come up with a list of stocks that they've actually purchased, whether it's imaginary that they've done on paper or for real, that is as solid as this particular list right here.
All right, let's go ahead and press on, save a little bit of time. Thought we talk about potential challenges to the portfolio. Again, one of the best practices we think that many investment clubs have instituted is to take and look at the companies in the holdings in their portfolio that have the lowest return forecast. In this case, the lowest projected annual return. And I've done that for the round table tracking portfolio. And the companies that have the lowest projected annual return are Cabot Microelectronics at 2.6, PetMed Express, which was one of my selections, at 4.1, and then Dollar General, BP, and Apple. Now, the portfolio isn't in dire need of being bolstered, as we'll talk about here in a second, but I do think that I would like to just go ahead and take the money and run on PetMed Express. I crunched through the numbers. I'm a little bit eager to let go of a company with a sales growth forecast of 3.5%, financial strength of 70. It's done its job. We invested about 9 months ago. That $1,000 is now $1,700, and that's one that I would just like to close out. Ken, do you have
I think that Cabot, Mark, is my choice, and that's another one that I would not consider a core holding. I went after it looking for a small company. This happens to be on that Fortune list that I just printed, but I'm looking for a small company that was fast growing. I think I might have found it a little tiny bit too late. It has made us some money. I don't know, is the relative return positive on this one, Mark?
I'm sure it is, because you're up 26% in less than a year.
Okay, well then I would go with dropping Cabot from the portfolio also. This one makes slurries and polishing agents for chip makers. Although chip makers are certainly on a roll right now and going to need more of this material, but I would not consider this a core holding.
Mm-hmm. And again, we should make the point, we can always come back to them, especially if they get a a resurgence of growth and a drop in stock price.
Absolutely.
So with that, I think we can probably just let these go and do our portfolio business, unless I've got anything burning a hole in your pocket.
The only comment I would make, and since I don't believe we have, I don't know if this was a Hugh pick or one of our guests, and it may be a combination, but BP is another one that is not what I would call a core holding, and outside of a compelling non-conventional reason to hold it, I would say that it looks, because I don't think it's been picked 6 times, so there's a reasonable chance we've got a decent return in it. Return of 0.1, I mean growth of 0.1 is flat, and then you're below the market potential return, and quality. Now financial strength is strong, but overall quality is very weak. So, again, outside of being some sort of special situation, and since I don't believe we had the stock picker here tonight to inform us of that special situation, I'd at least like to keep it on the radar screen and go ahead, since it's up there now, mention for the sake of the audience, this is one that I think in most cases should be looked at very hard.
Yeah, it is a 4-time selection, and it really was a special situation. So, again, it's up handsomely, probably not setting the world on fire, but it is up handsomely.
And again, for both Sharon, who's new, as well as a reminder to everyone, part of my comments on that is somewhat assuming, although it could have been a special situation that Hugh or whoever brought it felt strongly about, that was not picked up in our basic methodology. But anytime you see a par that is low, one of 2 things is happening to the company in most cases. Either it has tanked as a business and is potentially a very bad investment from a business standpoint, or it is doing well as a business and has done very well as a stock return, which makes the potential return, the par in the last column, be down. So, I'm suspecting that BP has perhaps done its thing. And
I wouldn't have any problems with adding it to Cabot and PetMed and dropping it, Mark.
Yeah.
And I'm focusing on the growth, the 0.1% growth. We would like to see a little bit more growth in this portfolio, so every little bit helps.
And obviously these changes won't make too big of a difference, but every little bit does help. So let's go ahead and run that up the flagpole and dump the BP, and we can always come back to it. I mean, I just noticed recently that even Schlumberger is looking kind of intriguing again. So if you believe that there's a future in the energy business, then some of that probably makes sense. Ken, would you like to walk us through the portfolio report card and give us the
Sure.
Reader's Digest version?
Absolutely. I don't see my par on the slide today, Mark, but on the Manifest Investing website.
Call it 8%.
8%, okay. On the Manifest Investing website, every night, a value called MyPar, Manifest Investing Potential Average Return, is calculated. It's the average par value in the entire database, and tonight it's around 8%. So our par at 12.2 is better than 4 points above the average. Our goal is 5 points above, so obviously if we want to raise that a little bit, you sell low par product and you replace it with high par product. So we're doing the right thing if, in fact, the stocks that we choose tonight have higher pars and we choose to lower or to unload these 3 stocks that we're talking about. Our growth is sitting pretty nicely right now, although I'd like to keep it at 12 or even 12.1 or 12.2. It's considerably improved from where it was about a year ago when it was down at around 11.1, 11.2. This is sales growth, and remember, the more sales growth, the likelihood is that you have a smaller company. We set numbers of 7 and 12, and we say that sales growth under 7% is a large company, and sales growth above 12% is a small company. Those are rules of thumb which have all kinds of counterexamples to them, but they do help us keep our portfolio valued at a place where we have the opportunity to beat the market by the 5 points we keep talking about. The financial strength, the earning stability, those are pretty decent numbers in the portfolio. I like to set around 75 or 80 as the target for them. So the growth is coming close to where I'd like it to be. The PAR is close to where I'd like it to be. And unloading these 3 companies and replacing them with our 3 choices tonight should only improve the numbers that are a little bit low right now.
Thanks, Ken. I just wanted to spend just a quick moment looking at a 5-year chart just to make a point that I don't think is actually being caught much in the mainstream media. What you're looking at is a 5-year chart of the S&P 500. That's the bars. They call them candlesticks, but the bars kind of going up the middle. And what I'm doing is making a side-by-side comparison with the value line arithmetic average, which is this $ VLE, and it's this green area that you can see in the background. Now, again, as Ken was just alluding to, we encourage all of the above investing, and what we mean by that, make sure that you have a suitable balance of small, medium, and large companies. The value line arithmetic average does that. So the green bar is basically, the green area kind of is reflective of the type of investing that we do. And what I want to draw everybody's attention to is over here on the right, because the recession, almost bear market in some of the smaller company stocks over the last year means that the value line arithmetic average has actually lost quite a bit of ground. So while you're watching the news anchors every night with the indices in their armpits talking about your 401k and the S&P 500 at all-time highs, the smaller and some of the medium-sized companies have not kept up with that. And that just is an area rich in opportunity right now. So again, there's no better time to be doubling down your efforts on discovering promising small and larger companies. And this just shows you that they have been languishing for quite some period. All right, one other thing that we check in for some of our sell criteria. Anytime a company in its first year or 18 months of being in the tracking portfolio drops more than 20% relative to the stock market, we give it something of an automatic sell consideration. And in this case, TD Ameritrade did get caught in that pretty nasty situation where they reduced their online trading commissions to 0. And Schwab dropped 10% in comparison to Ameritrade dropping something like 30%, maybe 40% overnight. But you can see that it is trailing. And so in keeping with our rules, we can always come back to it, because I actually think TD Ameritrade is a pretty good company. It actually has triggered that sell stop, a protective sell stop. So again, I tend to try to think of this as we explain this to people who are trying to come to grips with the situation. We're not locking in a 20% loss. We're attempting to protect 75 to 80% of the capital in these positions. And of course, we do an entire webcast on that subject alone. So this one qualifies, and Schwab actually survives quite nicely. Any comment, Sire Ken?
Well, you know what I'm going to say, Mark. I'm going to say that we're in the middle of an experiment, and now's not the time to be of faint heart. If the experiment is telling us that this is a dump, let's dump it, and let's set ourselves a time to conclude the experiment so we can get some results that we can actually speak of with some certainty. So maybe the experiment runs another 8 months or 10 months or 12 months, but we are in the middle of it right now, and I say let's follow what we said and go ahead and remove it from the portfolio.
Yeah, and as a shameless plug, we will be covering some of the performance update at the Puget Sound in Seattle. They have an investor fair coming up in a couple of weeks. We'll be updating it there and sharing it with the audiences here over the next couple of months. But I would agree. The last thing here is we've been trying to watch any company that has a quality degradation where it's dropping from excellent quality to good quality. We triggered Biogen last month, and it was kind of interesting because everybody was in kind of a panic over the abandonment of their Alzheimer drug, and then a few days later they unabandoned it. And this is just shows yeah, it should be probably on the hot seat or on the radar screen to watch carefully, but it basically recovered to where it was. The quality's gone back up, the price has gone back up to previous levels, and the return forecast is back down at approximately 10%. So it's also a lesson in maybe giving a high quality company like Biogen some room to run when you're going from 82 to 78 in quality.
Yeah, the one thing that I would just comment from the quality degradation experiment, if you want to call it that, it's really not so much an experiment, I wouldn't say, because from the very beginning of the Better Investing NAIC methodology, George Nicholson and others have talked about getting rid of companies when there's a shift to negative quality. It's just what is new is this idea of quantifying quality that you've brought us, Mark, through Manifest, and then in the last, couple of years that Ken has really pushed us to watch it as a leading indicator of stock loss, potential stock price loss, all of which I think is good. What I was just pointing out, though, in Biogen's case, is all in all, although it did dip from excellent momentarily into the good level, so it lost a notch, if you will, that's still a relatively steady flat line, both in the decline as well as the increase. Many of the examples we've looked at previously have been drop-off cliffs.
Yes.
And so, I just kind of point that out, that even though it did shift from kind of the bottom of the excellent into the top of the good, and so technically it's declining quality. And there was stuff, and I'm not saying Biogen as a company didn't need to be looked at for all the reasons you just summarized, Mark. It's just from this idea of quality degradation, that graph is not that alarming to me.
I agree with you completely that one of the things, if we're going to deal with quality degradation, I think we need to to quantify how large a degradation becomes before it really concerns us. And you're absolutely right. I'm not especially concerned when I see that line dip into the 79s from the 82s or 83s. I would be concerned if that line dipped into the 69s from 82 or 83s. I think that's enough for me to take notice, but I'm not sure that this quality line right here would have done anything except my remark might be that there's been gradual quality decline over a long period of time, but it's been extremely gradual.
Yep, I'm with you. And maybe we do need to talk about the velocity of quality, but not right now. All right. And one last thing that we have promised to take just a quick look at is monitor for companies that are getting up there. So they could be potential candidates to take a closer look at to sell if the relative strength index gets above 70 or above 80. Notice that Biogen, by virtue of their recent price movement, is at the top of this chart. And again, I don't see anything on there screaming, let me go. And down at the bottom, when we would like to take advantage of opportunities to catch a company down in the relative strength index of 20 or 30, as long as everything else makes sense. And I know it's hard for you to stay away from companies like Infosys, but It's actually a worthy study right now.
Yes.
And by the way, when Cy and I added it to the portfolio, I just looked today, we bought it at $5 or $6. So that price drop isn't bothering us too much yet. All right, let's go ahead with the stock presentations. Ken wants to play with blocks.
Well, I want to double down on Google. I brought Google to the roundtable in August of 2019. At that point, we did not own very much of it, so I asked us to add another position in it, and I gave some good reasons. I went back to my August slides and I updated them, but I found I didn't need to do too much to present a pretty decent case for this stock. So if you could show me the next slide, Mark. Here's the MyPar at the time that Google was being looked at in August, and MyPar was 8.7. Today, MyPar was just a little bit above 8. So we didn't really see that much change in what's happening on our basic numbers. We also didn't see much change on our portfolio itself, although I will say that we were pushing our par value a little bit higher every single time we had been working, and we had been keeping our growth around 12%. So I wasn't too concerned about having to do any heavy lifting in any of these numbers. But here's the screenshot from August, and the screenshot today is pretty much the same. Next slide, Mark. I went and did a stock search, and I set some pretty high standards for this stock search. I asked for 13% par going forward, and then I asked for 80% quality, 80% earning stability, 80% financial strength, and at least 12% growth as far as sales were concerned. You see that I got a very short list, and the short list included Google at the very top. I'm familiar with the company. In fact, I own 4 out of 6 of these stocks right here in various portfolios that I manage for myself and my wife. I like the growth number for Google at 18.6%. I think that's exactly the kind of growth we want to put in our portfolio. And here's one of those examples that prove the rule. You know, you could write all kinds of rules, and then you always have people telling you a counter example to the rule that you write. We always say small companies grow at 12% or better. That's typical. But when I can find a giant company, a mega-sized company that also grows at more than 12%, I don't really know what to call it, and I don't really care what I call it. I just know that it's an opportunity for investment. And here we go with one of the largest companies in the world growing at more than 15%. We can argue as to whether that number should be 16, 17, 18, 20, 21, but I'm going to just say it's growing at more than 15%, and it certainly presents an opportunity. Next slide, please.
Yeah, just one quick comment as we proceed here, Ken. This reminds me of the discussions we had on Apple 7 or 8 years ago. You know, Apple being quite a large company in reality, but tending to behave like a smaller company. And when I watch the stuff that Google's getting into on a daily basis, I tend to think that they're also behaving like an innovative small company. So I see some parallels between, 7 or 8 years ago with Apple and Google. And I know many members of this audience have been very suitably rewarded by Apple over that time frame. So interesting.
These are snippets from the top left corner and bottom right corner of the August 9th value line, and we don't have a new value line coming out yet. The new one for Google will be out next week, so things haven't changed since I presented this in August. except that I did update these paragraphs. Google's now been chosen 4 times, and the holding is now worth more than $6,500. It was $1,225 at this Value Lines Publishing in August 9th, and it's $1,290 at the end of trading on Monday. Now, it was down a little bit today. It had an earnings report, and frankly, I really liked what I heard from some of the more thoughtful analysts on television in the last 24 hours, who I think made a great point that Google is not especially concerned about managing their earnings per share numbers quarter to quarter to quarter. In fact, Google deliberately classifies some of their businesses so that they're hard to analyze because they are so experimental. They are so cutting edge. They are doing things that you don't expect. Google also carries a large cash position. That's the same thing that Mark was saying with the similarities to Apple maybe 8 or 10 years ago. And I'm not especially concerned by the Google report. I did listen to their earnings call yesterday, and I felt very comfortable with what they had to say about their forward-looking business. One more slide, Mark. Google has the market on 85% of all search, and that's monetized so that it gives a great deal of advertising revenue coming from that search. The revenues are generated by general ads, but they're also generating a lot of revenue from targeted ads. About half or more of the business of the search comes from outside of this country. If you look at the Chronicle, that's the graph that I have displayed here on this slide, you'll notice that back in August, Google was trading at a value, a par value, that's the red line, and it was trading at a par value back in August, which was certainly the high point for the last 3.5, 4 years. Well, it's up there again at the same general place, and that to me signifies somewhere where I would like to buy a stock when it's trading at something with a traditionally high par value. Google also does not trade at one of these lofty PRs that makes it so difficult to grab and hold on to, and that bad news so often crushes them. So I'm not looking at a 45 or 50 or 55 PE value, but rather I'm looking at what I feel to be fairly honest PE values, especially when I consider the sales growth rate for the company. Next slide. Here's the sales line, the pre-tax profit line, and the earnings line. And this is before yesterday's earnings were announced. Of course, those numbers won't fall into our database for another day or two yet, but they will be on trend or virtually on trend. Notice that I did exclude 2017 from the graph. That's the Tax Act year, and Google had to pay significant repatriation tax for its foreign businesses, and that caused the data to be really out of trend, and I excluded it knowing why the data was where it was. Next slide, please, Mark. There I am excluding the 2017 on the fundamentals up on top, and I decided to let sales run at 15 and let earnings. I wanted to hold the company's toes to the fire. So I wanted to see how low could earnings go and still give me a good solid buy. So I used 13. I could have used 15 or even 17 where a lot of the analysts are today, but I'm using 13 looking to see if that will generate a buy. When I get down to section 3, checking out my PE values, I'm using 30 and 20 to go forward for averages. feeling that the PEs are going to moderate as the company does grow. But I also feel that that 23.6 current PE is a very honest PE value for a company that's probably growing somewhere between 15 and 20% year over year. Next slide, Mark. Well, I put all the numbers together on the stock selection guide, and I get a par value of 12 up to a total return value of around 16. That's circled on the bottom right-hand corner there. I like to think of that as a range that's probably where the return will be for the next 5 years, annualized. And I'm going to take that, especially for a company that sells as much as this company sells, and is as large as this company actually is. I would more likely expect this company to be returning me something in the neighborhood of 6, 7, 8%, and I would be expecting it to pay a fairly decent dividend and to be fairly mature. Well, Google is none of those things. It does not pay a dividend. It's acting like a very small company, and I'm going to ask that we put one more a lot of Google into the roundtable portfolio.
Okay, thanks, Ken. Hey, did you catch the news that they invested $40 million into Fossil watches today?
Yes, I did. They were kind of laughing at how it seemed like a really big purchase until you looked at how much money Google actually had, and then it was just sort of like them buying a watch for the company, just like if you bought a watch for yourself, you know. So they weren't really concerned about how much they had to spend on that. Oh, I guess I had one more slide just showing where Manifest was on par. Remember, I was considerably lower on sales growth. Manifest is using 18.5%. I was using 13. Manifest and I were both using 25 for the average PE. And I just captured that industry kind of information just because it was so interesting. Google comes out on top in the internet content and information industry, and it comes out top in the communications sector. So I'm interested in putting high growth companies that I think have a reasonable chance to move on. Cy, you'll be interested to know that my third choice tonight was Texas Roadhouse, and my second choice tonight was Facebook. So I'm going to let you put my third choice up tonight. The only reason I didn't go with this is I just don't like to buy restaurants. So we'll take it away, Cy.
All right, thank you, Ken. And to the last comment that you mentioned, I would just remind some of the portfolio return of Buffalo Wild Wings, which when it was bought out, I think it did very well. And while I don't think it's been a whole lot in the roundtable, there's probably many on this call that maybe at times have made some money in a little company called McDonald's over the years. But here is Texas Roadhouse. And interestingly, Ken, my stock screen that we'll see in just a minute was actually relatively close to yours, but not quite as stringent. And Cantel Medical did pop up as it did on yours, and I'll explain why we didn't go in that direction. This is Texas Roadhouse, and you'll be seeing a number of times on several charts, nice up, straight, and parallel, as this chart does. Very consistent sales growth as well as earnings growth over the last 10 years and projected into the next 2. Next slide, Mark. And I mentioned the stock screen that I did. I used the same par that Ken did at 13, also 80 quality. For some reason, I have, even though we're late in a bull market, and I would normally be keeping a pretty tight financial, just for screening purposes, I decided this month, and I've been doing it for the last few months, screening at a 70, which is still a very good financial strength, but just a little below my normal excellent requirement. At this stage of the market, Ken did have a tighter financial strength, and then I used 10% growth, looking for growth. And the companies that kind of popped out at me for various reasons was Cantel Medical, Transdigm Group on aerospace and defense, and then you see Texas Roadhouse. There were a couple others that caught my eye that would have been new ads that you can, of course, see on here. Some companies, many companies, in fact, that are in the portfolio, to include Alphabet, Google, that Ken has just presented. I was looking for a new company, so that's why some of those are out. And I was also trying to keep a relatively low, or at least not an outrageous PE projection as well. So I looked at all three of these companies. Next slide. Here's Cantel. I've given you an excerpt of Manifest's summary of Cantel, which is on the right side. Notice a very aggressive potential return par of 22.2%. And notice the chronicle that Ken showed you for Google, the one for Cantel also shows that it's near, actually above an all-time high at the end of last month in absolute par and pretty close to an all-time high in relative par. What kind of started steering me away from Cantel, I was almost ready to pull the trigger from looking at it, but notice the historical PEs, average of 26.9, current of 43. And in fact, I was going to use it as a little bit of a teaching point that you can get a good return out of a stock even with PE decline when it's very high and you have good solid growth. Notice my projected PEs, but my total return just didn't come out high enough for me to consider. But also what gave me concern with this company was, again, the high PE and the fact that some of its businesses are going away. This Cantel is a medical sterilization company and they're big into dialysis. Their water purification is a big part of their business and is growing, but dialysis equipment sterilization is a dying business. And all of that, I just said, it may be a good company, but I'm not really interested in taking a chance on it at this stage in a bull market. Maybe after we see a market dip and so forth, it might be more attractive. Next slide. So I went back to Solomon and again, trying to stay away from higher PEs. I sorted in reverse order by PE from low to high. And you see TDG and Texas Roadhouse popped up as high quality and high return companies. So I looked at both of them. Next slide. And here's TDG. Again, biggest problem that I saw with it, as you could see from this slide, it's a relatively steady sales growth company, but it operates in the aerospace industry. Looks like something that is probably a worthy study, but again, was more cyclical than I thought appropriate for tonight. So I decided that I would feast on Texas Roadhouse. Next slide. Yes, pun intended. Up straight and
unintended, please.
But here we go. After seeing those other companies that I think are worthy studies, but challenge us a little bit, again, especially given the uncertainty, what better opportunity than to turn to a good, solid restaurant, people need to eat sort of company with a solid record all the way across the board with sales, profitability, and earnings per share. Next slide. I did, as I usually try and do, a quick industry study ranked by quality. And you see here Starbucks and McDonald's are slightly higher quality, although all of the blue companies down through Yum China are excellent quality. Not a whole lot of difference between them. Notice of these companies, Texas Roadhouse does have the highest potential return as well as the highest growth. So that's what kind of steered me in that direction. Also, I believe Starbucks is in the portfolio, so that would not have met the new stock criteria I was looking for. Next slide. Legendary food, legendary service, and we're looking for legendary returns. This is the cover of the annual report from last year. Next slide. Texas Roadhouse operates its namesake company, Texas Roadhouse, where you buy steaks and throw peanut hulls on the floor. They currently have 498 company-owned and 93 franchise locations. The company reports both company-owned and franchises in one segment, and I did not seek to dig in the company deep enough to distinguish between the two, but do realize that in the restaurant business or any business that has franchises, you have a higher profit margin generally in franchise locations than in company-owned locations, because the company does not own the property and does not have all of the operating costs reflected in the revenues. They're just taking a share of the profits earned by the operators. Bubba's 33 is a new concept by Texas Roadhouse. They're trying to be a little more casual and move into sports bar business. Value Line sees this as an attractive growth opportunity because it will not cannibalize, they don't believe, the traditional Texas Roadhouse. They are in 49 of the 50 states, 10 foreign countries, and again, given where we are in the business cycle and market cycle, no long-term debt, and a solid dividend of greater than 2% is attractive. Next slide. Back again, up straight and parallel. Can't get much straighter lines than this. I chose to go ahead and use as my projected sales growth just a notch under the historical rate, and it really is in line with the last 2 or 3 years of 11%. That's a tad below, I think it's 13.6 that Manifest and the analyst consensus have sales growing at. I chose to use the 5-year average pre-tax profit margin. Again, profit margins, as you can see, by at least the pre-tax total line have been generally consistent, don't vary a whole lot. So I just use the 5-year average. I use the company, by the way, you'll hear in just a minute, reported earnings today. They beat expectations on both sales and earnings by a significant amount, and the company is projecting their taxes over the next few years to be 15%. So that's the rate that I used, and then I used Value Line's projected shares. All of that gave me projected earnings 5 years from now, $4.45. Next slide. I just, again, a company that is as consistent as Texas Roadhouse has been. PEs have generally been consistent over the last 10 years, although a pretty consistent uptrend as the bull market has matured, as interest rates have generally remained low, and given the company's consistency, the market has drifted higher in its valuation of the company over the last 10 years. But both the average and the median return or high and low PEs are about the same, and I chose to use the medians for my study. to give me a potential high price of 119 and an average PE of right around 22. Next slide. And then that gives me, using today's price, potential annual return almost identical with Ken's pick, except the 16.3 on the total return using high PE is just a tick above the Google's, and the par average return is at 12.1, which is the same as Google. And notice the top of this slide. The price appreciated 20% today. Mark, you should have had this last night. And we could have gained that 20% price appreciation. But even after the significant jump in price, it's still a solid add to the portfolio, as you can see on the next slide. This is the chronicle for Texas Roadhouse. The green line that I have drawn in from just under the 75 that you see in the left-hand column to under the 15 in the right-hand column, that is 12% average return, which is where Texas Roadhouse is today. And as you can see, it is right in line, again, with that historical average. And look at the not historical average, historical high that you see back in middle of 2017. And notice the significant price appreciation that was experienced following that time. So I think, again, there is a excellent opportunity here in Texas Roadhouse. So I'm adding another 1,000, or adding Texas Roadhouse to the portfolio.
Well, thanks, Si. Yeah, Ken and I have talked often about how 2 out of the last 3 years, a restaurant, one of them was Popeyes. I don't remember what the other one was, Ken, has actually led the small company results quite magnificently in a couple of cases. So restaurants can be a good thing. All right, what I thought I would do is wrap things up by just showing a quick summary of the leaderboard for the small company, best small companies as we search. I'm going to start with the Baker's Dozen top 13. This is a work in progress. But what I'm basically showing you is a list of companies that are somewhere in the $1 billion or less revenue column. We're going to allow them to be a little bit higher, and we're not chopping them off quite as low, thanks to our experience with Simulations Plus. So you can actually see the trailing 12-month sales for these companies is all right here. Every single one of these will have double-digit growth expectations. That green column is all the growth expectations. And all of the companies here, by virtue of the way that we keep track of companies, they're going to have decent return forecasts, attractive return forecasts, and either good or excellent quality ratings. Ranking. So they basically add up to a group of companies that are worthy of study. You've heard both Ken and Si mention a few of these that could be raked over the coals. And taking beyond that, there's basically this parade of opinions that we've come to look at here on a month-to-month basis. The relative strength index, we love to see them. We like to see them at 30 or less. Love to see them down near 20. So I just went down the list and grabbed a couple that met that criteria. That 52-week position, that's the difference between the low and the projected 52-week high. And much like Hugh McManus, we like to see those down close to zero, certainly less than 20%. And you can see we've got a handful of them that meet that criteria. Now, Value Line, it's fairly typical of Value Line to struggle with early stage or relatively small companies, so that doesn't give them any heartburn. You can see that Canada Goose is the one that they have the highest expectations for. But again, Value Line does tend to struggle with the smaller companies in that regard. That owner's return on capital, again, that's factoring in any debt into the situation, and it's something we've talked about. The numbers should resemble the projected annual returns, maybe a little bit lower, but the highest owner's return on capital, you can see I've circled them there. And the Morningstar, price to fair value. Again, anything below 100 is potentially on sale. Anything that gets down into that 70, 80 range is fairly attractive. If it gets much lower than that, a little bit more speculative. So again, I've circled 3 companies that are down in that kind of 80%. Again, that's suggesting that they may be at a discount of 20%, approximately 20% to their fair value. Same thing with the analyst consensus estimates, that price to fair value. You can see that the analyst consensus is actually more optimistic or more bullish on some of these companies, including that BioSpecifics Technologies. And again, the 1-year analyst consensus total return expectation, again, that's 1 year out. I circled the highest one, and you can see that BioSpecifics Technology kind of runs the table here. So that's the company I'm going to go with. And again, these are towards the top of our best small company shopping list at this point in time. What does BioSpecifics do? They make collagen A's. And you got to start with collagen. So I grabbed Wikipedia and I said, well, what's collagen? Well, collagen's in all of our bodies. It makes up like 30% of our bodies. It's basically a protein that is involved in the structure, kind of holding things together. You can see that, what's a stock study without a little bit of etymology? The word itself comes from the Greek glue. So collagen can be thought of as basically living organism glue. So what's a collagenase? Well, it's basically the anti-glue. Enzymes which basically break things down. Because again, like many things in life, collagen's a great thing. But you get too much of it in the wrong place, in the wrong type of condition, and it starts to cause things like frozen shoulders and different things. And the collagenase is used to actually give relief to the patient who needs it. Here's a quick look at some of the areas where this BioSpecifics is actually, they are the originators of injectable collagenase, and you can see some of the areas that they're actually working. They have a treatment in place for the Dupuytren's contracture. That's where the hand kind of is forced into a fist, like a clenched fist, and you can't open up your hand. Again, the injections have been giving mobility and allowing hands to open. Peyronie's disease is a disease about a certain part of the male anatomy that actually begins to bend and can be quite painful. It's actually found in 3 to 6% of males. And these are both products that are in place and helping patients at this point in time. Now, they also use it in cellulite conditions. You can see the lipomas. That's basically the cysts or that type of thing, collections of fat underneath your skin that can be taken out. The lateral hip fat. So this is an answer to the question, do I look fat in this? Well, here, take this injection, that'll take care of it. No, I didn't mean, I'm kidding. That would get me in a lot of trouble. But one that I do find fascinating, this uterine fibroids, they are having some success and moving along fairly rapidly. So they've got solutions that, again, using this anti-glue to break down the collagen where it's doing harm, not good. Some really neat stuff in place and working. It's not a new company. It's a small company. But you can see here that they've got 10 years of stock trading history. It does have some volatility. We are in the middle of one of those downward volatile moments right now. The price actually peaked out earlier this year near 70. It's back down in the high 40s now. So again, this is not anything new and certainly not anything that would surprise us over the long term, but is a potential buying opportunity on the basis of that price chart. Here's a look at the fundamentals using the stock selection guide methodology. Again, if you didn't know the company and you covered up the numbers on the y-axis scale on the left, you would look at that and say up, straight, and parallel. What comes to mind for me is companies like Neogen, and which has been very good to many of us. Simulations Plus, which has basically saved a bunch of our portfolios this year. So again, that type of pattern, not quite as up, straight, and parallel as Size Restaurant, but pretty close considering that these guys are in an innovative field of development. So again, we're talking about a company that's demonstrating a 14% growth rate, extremely high margins. Sneak a peek down here at these margins. Oh my. we're basically looking at 50% type consistent margins. Well, what is kind of fascinating about the company is they have outsourced much of their development activity, including marketing, to Endo. You saw on that slide a few slides ago, there's 5 full-time employees on staff. So again, dramatically profitable in that 50 to 60% range. I used 55% for purposes of coming up with an estimate. You can see that they only have 8 million shares outstanding. Using a PE of 27-ish for a company with these type of characteristics is certainly reasonable. That generates a projected annual return of about 22%. A very interesting number. The return on owner's capital is about 16. No debt. A fairly good size chunk of change in the checkbook. Relative strength index down around 30. I'm having a hard time not liking a lot about this company, and there's a lot of good stuff going on. On the downside, it is a small company, and that red box shows you a reality of investing in some of these type of companies. There's one analyst covering the company. So again, we track the analyst consensus for these companies. The analyst consensus here is a solo effort, at least at this point in time. So again, if conditions change or if this individual changes their opinion, that can make a fairly dramatic shift virtually overnight in the company. You can see fairly robust numbers expected. Those are the numbers depicted on that graph. You can see 15% growth rate down at the bottom. But again, it is the work of a single analyst. So I'm going to go ahead and throw BioSpecific on the fire, and just a lot to like. And I think these smaller companies with the decent growth rates are just the type of thing we need. I'm going to skip over Hugh's Ardelyx slides for tonight, and I think we can.
Mark,
go ahead.
Can I add something to your BioSpecifics? If you remember, I presented it 5 or 6 months ago, and if you back up to the different treatments it has,
sure,
right there, you'll notice that cellulite treatment right there, it's been given to Endo, and it's actually been approved for marketing, and the treatment is dramatic in removing cellulite or the appearance of cellulite from the places on men's and women's bodies where it typically shows up, which is in the thigh, the butt, the arms, places like that. It's a dramatic cosmetic change, the use of this collagenase to remove this cellulite, and I think that's completely underrated and under the radar right now. The product has been approved for marketing, and they're in the phase right now of rolling it out to various places to actually be sold. So I just wanted to add that to it, even though people will vote for your stock. You deserve a win every now and then, Mark. So.
Oh, thank you, sir.
You're welcome. So let me go to the polls now and launch this poll, okay? That's the wrong poll. Hold on. That's the right poll, and here we go, launching it. So, folks, all you have to do is choose one of these 3 stocks. And if you don't like any of them, then choose none of the above. We like to have at least 80% of our audience voting. And we just crossed that 80%, 85% voting, 88% voting.
You guys are quick.
9% voting. Let's get 5 or 6 more of you voting, and we can go to 90 here. I'm going to count to 10, and then I'm going to close it down. If you haven't voted, it doesn't cost anything for you to cast a vote on one of these 3 right here. So let me close the poll and share the results. And sure enough, we all would like to get rid of our collagenase, of our cellulite. So we're going to hope that BioSpecifics accomplishes that for us. BioSpecifics, 61% of the audience. Google, 28%. Texas Roadhouse, 11%. So, Mark, why don't you add 2 positions for BioSpecifics into the portfolio, okay?
We'll do that.
And I'm going to hide that. And you're ready to go to the next slide then, Mark?
Yep. Why don't you go ahead and tell people where we're going to be at?
Well, we're going to be in Seattle on November 9th. Mark and I are going to do a number of classes together, and then he has a couple he's doing by himself, and I have 1 or 2 I'm doing by myself, and we should have a really good time. It's always a great event out there. If you're looking it up on the Better Investing website, remember that Seattle is in the Puget Sound chapter, so look for the Puget Sound chapter, and you should find the event and a way to get ready to deal with it. The following weekend, my own chapter, the Mid-Michigan chapter, is going to be having our I think it's about the 13th or 14th annual Stock Pickers Breakfast. We're going to be up in Saginaw. We'll be looking at the results of our annual contest. We'll be having a lot of fun, and we'll be wrapping it up just in a morning. So it's a great time to come out. It's a beautiful time here in Michigan right now with all the colors. So if you have a chance to make it up right there, we're the Mid-Michigan chapter, and you can find registration material on our chapter's part of the Better Investing website. The roundtable will be in November, and I can actually give you a date for the November roundtable. The November roundtable will be on the 26th of November. That's the Tuesday before Thanksgiving. We'll also be doing an investing topics webinar, and that webinar will be on December 3rd. Mark's going to be in Sacramento. The 2 of us are going to be in St. Louis in April and Philadelphia in April. We still have a few more dates to fill in. Cy, have you gotten any other invitations that we don't have on the list here?
Nothing that's during that time frame. Of course, we'll farther out. I suspect we'll have Bink for all of us, and
Yep.
and
don't
then
forget
Atlanta just invited me next August, so those are out there, but that's out of ways.
Okay, well, don't forget that Mark and Cy and I will be in at the convention in Dallas in May, the national convention. That's always a great time to take a lot of classes and meet a lot of really interesting people. So if you get a chance to come on out, now's the time. Mark, you can close the formal program down now, and I'll try to handle questions now and get them out to you so we can take a look at them, okay?
Okay, thanks everybody for your submissions, and thanks to the audience for checking in with us and basically inspiring us to keep pressing on and finding great companies to study together. Thank you so much.
Yeah, and while Ken's collecting his thoughts on the questions, I'll just give a shout out and a thank you to the North and South Carolina chapters for their event last weekend in Fort Mill, South Carolina, which is actually just south of Charlotte. So right there on the North Carolina, South Carolina border. It was a great event, and I appreciate being invited.
Did you have a nice audience, Si?
Yes, we did. It ran around 40. I think it was about the same as y'all had last year.
Great, terrific. So we're getting